Before we begin, it's crucial to understand the nature of this presentation. The information provided in this video is for educational and informational purposes only and should not be construed as financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. We are not financial advisors, and you should seek advice from an independent financial advisor if you have any doubts. All strategies and case studies discussed are for illustrative purposes and do not represent any guarantee of future outcomes. Imagine this for a second. You've spent the last 6 months glued to your screen. You've learned about pips, lots, and leverage. You've backtested strategies until your eyes were blurry. You finally found a system that works. You deposited $5,000 into a shiny new trading account with a broker that offered incredible 500-to-1 leverage. The gains started rolling in. 5,000 became 7, then 10, then 15,000. You feel like you finally cracked the code. You go to bed feeling on top of the world, dreaming of financial freedom. Then you wake up. You log into your account ready for the London Open and you see it. A zero balance. Your heart drops. You frantically check your emails and there it is. A cryptic message from your broker about regulatory issues. You try their website. It's gone. The support chat? Disabled. The phone number? Disconnected. Your $15,000, your hard work, your dream vanished into thin air. This isn't some made-up horror story. This is the devastating reality for countless aspiring traders in the United States who make one critical mistake. They dive into the global Forex market without understanding that here, in the US, we are playing a completely different game, with a completely different rulebook. The world of Forex trading you see on Instagram, the one with Lamborghini driving gurus using insane leverage from brokers based on tiny tropical islands, that world is not the American reality. The United States has one of the most restrictive, most heavily regulated, and frankly most confusing retail Forex environments on the planet. And not knowing the rules isn't just a disadvantage, it can be catastrophic. It can lead you to unknowingly break the law, partner with fraudulent brokers, and lose every single dollar you've invested before you ever place a winning trade. But here's the good news. Understanding these rules is your single greatest advantage. It's the shield that protects your capital. It's the compass that guides you to legitimate, secure brokers. It's the foundation upon which a real, sustainable trading career in the US can be built. And over the course of this series, we are going to give you that shield, that compass, and that foundation. We are going to demystify the entire landscape of US Forex regulations, step by step. By the end, you won't just understand the rules. You'll know how to use them to your advantage, to trade with confidence, and to protect yourself in a way that 99% of other aspiring traders simply don't. So, why is the US so different? Why can a trader in the UK get 1,000-to-1 leverage while you're stuck with a fraction of that? The answer, like so many things in American finance, goes back to the 2008 financial crisis. When the global economy was teetering on the brink of collapse, Congress passed a sweeping piece of legislation called the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was a massive 2,300-page bill designed to prevent another meltdown. And buried deep within that legislation were new, iron-fisted rules for the retail Forex market. Before Dodd-Frank, the US Forex market was like the Wild West. Brokers could pop up overnight, offer insane leverage, make unbelievable claims, and then disappear with client funds. There was very little oversight. The 2008 crisis gave regulators the political power to say, enough. Their goal was simple: protect the consumer. Protect the average American from the immense risks of a market they believed was too volatile and too dangerous for the general public. This led to the creation of a powerful regulatory framework, enforced by two main organizations you absolutely must know. Think of them as the sheriffs of the US Forex world. First, you have the Commodity Futures Trading Commission, or the CFTC. This is the federal government agency, the top cop. They write the big rules. They have the power to levy massive fines and shut down non-compliant operations. They are the reason the entire landscape of US Forex changed overnight. Working alongside them is the National Futures Association, or the NFA. The NFA is a self-regulatory organization. Think of them as the deputies on the ground, Enforcing the CFTC's rules. Every single Forex broker that wants to legally operate in the United States and accept U.S. clients must be registered with the CFTC and be a member of the NFA. No exceptions. If a broker is not registered with both, they are operating illegally in the eyes of the U.S. government. This is the very first and most important check you will ever make. It's non-negotiable. So what did these new sheriffs actually do? They implemented a set of rules that fundamentally altered how Americans can trade currencies. They put a hard cap on leverage, drastically lower than what's available in most other countries. They banned certain trading strategies like hedging. They implemented strict capital requirements for brokers, forcing many smaller players to either shut down or leave the U.S. market entirely. And this created the central conflict for every American Forex trader today. On one hand, you have the regulated path, the path of safety, security, and legal protection. But it comes with limitations, lower leverage, fewer broker choices, and stricter rules. On the other hand, you have the siren song of the offshore, unregulated brokers. They flood your social media feeds with promises of massive leverage, huge bonuses, and unrestricted trading. They offer the illusion of freedom, but what they don't advertise is the risk. The risk that your money isn't protected. The risk that they aren't accountable to any U.S. authority. The risk of waking up to that zero balance we talked about earlier. Navigating this choice, this conflict, is the single most important decision you will make as a U.S. trader. And making the right choice requires a deep understanding of what these regulations actually are, why they exist, and how they impact you, your strategy, and your bottom line. It's about learning to thrive not in spite of the rules, but because of them. It's about shifting your mindset from chasing the highest possible leverage to building the most secure possible trading business. This series is your complete guide to making that shift. We're not just going to list the rules. We're going to dissect them. We'll explore the history, the intent, and the real-world application of each major regulation. We will show you how to find a fully compliant U.S. broker, how to verify their registration in under 60 seconds, and what red flags to look for. We will break down the leverage caps, the FIFO rule, the ban on hedging, and explain how to adapt your trading strategies to work within this framework. We will arm you with the knowledge to not only survive in the U.S. Forex market, but to potentially succeed, all while keeping your capital as safe as possible. Forget the noise and the hype. It's time to learn the real rules of the game. To understand the rules, we first have to understand why they were written. And the story of American Forex regulation is a story written in the ink of a global catastrophe. The 2008 financial crisis. Before 2008, the retail Forex market in the United States was, for lack of a better term, the Wild West. It was a frontier of incredible opportunity, but also one filled with unseen dangers, regulatory gray areas, and brokers operating with very little oversight. You could find leverage of 400 to 1, 500 to 1, even 1,001. This was marketed as a feature, a way for the little guy to control massive positions with a tiny amount of capital. But in reality, it was a razor's edge. A minuscule market move, a single pip against you, could result in a total wipeout of your account in seconds. There were stories of brokers with questionable practices, unclear pricing, and even outright scams. It was a landscape where the retail trader was often at a massive, and sometimes invisible disadvantage. Then the world changed. The subprime mortgage crisis hit, and the global financial system teetered on the brink of collapse. The fallout was immense, and the U.S. government, determined to prevent a repeat, embarked on the most sweeping financial reform since the Great Depression. The result was the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. It's a mouthful, I know, but for every U.S. Forex trader, those two names, Dodd and Frank, are the architects of the world you now operate in. While the act was massive, targeting everything from big banks to credit rating agencies, a specific section took aim directly at the retail Forex market. The goal was simple and clear: to protect the consumer. To take that Wild West and build a fortified, regulated city in its place, with clear laws and visible sheriffs on patrol. The two main sheriffs that every U.S. trader needs to know are the CFTC and the NFA. First, you have the Commodity Futures Trading Commission, or CFTC. Think of the CFTC as the federal government agency that writes the laws. They are the rulemakers, the legislative body for the derivatives markets, which includes retail Forex. They set the high-level framework for what is and isn't allowed. Then you have the National Futures Association, or NFA. The NFA is a self-regulatory organization. Think of them as the police force that enforces the laws written by the CFTC. They are the ones on the ground, conducting audits of brokers, creating registration requirements, and handling dispute resolution. Every broker that wants to legally offer Forex trading to U.S. retail clients must be registered with the CFTC and be a member of the NFA. This is non-negotiable. It's the first and most fundamental rule of the game. If a broker isn't regulated by these two bodies, they are operating outside of U.S. law, and you are trading with zero protection. So, what were the big landscape-altering rules that Dodd-Frank, the CFTC, and the NFA put into place? The first, and arguably the most impactful, was the leverage cap. The days of 500 to 1 leverage vanished overnight for U.S. traders. The new rule stipulated a maximum leverage of 50 to 1 on major currency pairs, like the Euro/U.S. dollar or the US dollar/Japanese yen. For all other pairs, the so-called minor or exotic pairs, the leverage was capped even lower, at 21. Now, for many traders coming from the Old West, or looking at what international brokers offer, this seems incredibly restrictive. Feels like a handicap. But regulators didn't see it that way. They saw it as a mandatory seatbelt and airbag system. They looked at the data and saw that extreme leverage was a primary driver of catastrophic losses for new traders. By capping leverage, they were effectively forcing a degree of risk management onto the entire industry. It reduces the potential for astronomical gains on a single trade, yes, but its primary purpose is to reduce the probability of an instant and total account loss. It's a safety mechanism designed to keep you in the game long enough to learn, adapt, and potentially find consistency. The second major rule that sets the U.S. market apart is the FIFO rule. FIFO stands for First In, First Out. This is a rule about how you must close your trades. It's a concept that can be a little confusing, but it's actually quite simple when you break it down. Imagine you're trading the euro to US dollar. You first buy one standard lot at a certain price. A little while later, the price dips, and you decide to buy another standard lot at a lower price. You now have two open buy positions. Under the FIFO rule, if you want to close one of those positions, you must close the first one you opened. You cannot choose to close the second, more recent position while leaving the first one open. The first trade you put in has to be the first trade you take out. This rule prevents traders from picking and choosing which positions to close, forcing a more orderly, chronological exit from the market. Now, why would they do this? The FIFO rule is directly linked to the third major U.S. regulation, the no hedging rule. In many parts of the world, traders can hedge their positions. This means they can hold a buy position and a sell position on the same currency pair, in the same account at the same time. For example, you could be long one lot of euro to US dollar and simultaneously be short one lot of euro to US dollar. In the United States, this is strictly prohibited. You cannot do it. The NFA views this practice as being detrimental to the retail client. Their logic is that a fully hedged position, one lot long and one lot short, results in a net position of zero. You have no market exposure. However, you paid the broker spread to open both trades, and you might be paying overnight interest or swap on both positions. From the regulator's perspective, the only party who benefits from a direct hedge is the broker. They believe it's an economically redundant practice that just adds costs for the trader. The FIFO rule is the mechanism that enforces this no hedging policy. By forcing you to close your first trade before any subsequent ones, it makes it impossible to maintain offsetting long and short positions. These three pillars, the leverage cap, the FIFO rule, and the no hedging rule, are the foundational elements that make the U.S. Forex market a unique ecosystem. They were all born from a desire to protect consumers from what regulators perceived as excessive risk and harmful industry practices. For some experienced traders, these rules can feel restrictive, especially if they are accustomed to strategies that involve hedging or high leverage. But for the person just starting out, they create a trading environment with built-in guardrails. They force a more disciplined approach to risk and eliminate some of the more complex and potentially costly trading tactics right from the start. They fundamentally change the risk-reward calculation for every single person trading Forex within the United States. But these rules governing your trades were only one half of the equation. The other, equally critical half was about protecting your money itself. Regulators knew it wasn't enough to just control how people trade. They had to control how brokers handled the money you deposited. They needed to build a fortress around your capital, ensuring that a broker's financial trouble wouldn't mean the disappearance of your entire trading account. And the rules they put in place for this are some of the most robust in the world, creating a clear dividing line between regulated U.S. brokers and many of their offshore counterparts. Understanding this capital protection framework is absolutely essential. It's the difference between trading with a safety net and walking a tightrope with no net at all. And that's precisely what we will deconstruct next. The specific regulations that dictate how your money is held, protected, and secured. Let's start with the single most important protection you have as a US-based Forex trader: segregated client accounts. Imagine you walk into a bank. You can either deposit your money into a general checking account, where it gets mixed with everyone else's money and used for the bank's operations, or you can place your valuables in a personal safe deposit box. The bank can't touch what's inside that box. It's yours and yours alone, simply held in their vault for safekeeping. A segregated account is the financial equivalent of that safe deposit box. U.S. regulations mandate that every dollar you deposit with a Forex broker must be held in an account that is completely separate from the broker's own operational funds. Your money cannot be used to pay the broker's salaries, their rent, their marketing bills, or to speculate in the market for their own corporate account. It is walled off, earmarked specifically as client funds. This isn't just a friendly suggestion from regulators. It's a hard and fast rule with severe penalties for violations. The broker is merely a custodian of your trading capital, not its owner. This might sound like a simple common sense idea, but its importance cannot be overstated, and it was a lesson learned through the crucible of financial disaster. To understand why this rule is so foundational, we have to look back at the collapse of firms like MF Global in 2011. While not exclusively a retail Forex broker, its failure sent shockwaves through the entire financial industry and provided a brutal case study in what happens when client funds aren't sacred. MF Global was a massive century-old firm. It was a giant, but it made a series of colossal high-risk bets on European sovereign debt that went disastrously wrong. As the company started to implode, it faced a severe cash crunch. In a desperate and illegal attempt to stay afloat, the firm dipped into its customer accounts. They took money from those safe deposit boxes to cover their own operational shortfalls. When the dust settled, an estimated $1.6 billion in customer money was simply gone, vanished. It took years of legal battles and bankruptcy proceedings for customers to get a significant portion of their money back. Farmers, small businesses, and individual traders who thought their money was safe were left in financial ruin, their accounts frozen and their capital missing. The MF Global collapse became a defining moment for U.S. regulators. It was a stark reminder that even the biggest, most established firms could fail, and that without an impenetrable wall between company money and client money, the clients are the ones who will always pay the ultimate price. This event is precisely why the CFTC and NFA are so relentlessly strict about fund segregation today. They saw the abyss, and they built a fortress to prevent anyone from falling into it again. But the protection doesn't stop there. It's one thing to say the money must be separate. It's another to ensure the broker itself is financially stable enough to withstand market shocks. This leads to the second pillar of your protection: stringent capital requirements. Offshore brokers might pop up with a few $100,000 in the bank. In the United States, that's not even close to being acceptable. To operate as a registered futures commission merchant, which includes offering retail Forex, a broker must maintain a minimum of $20 million in adjusted net capital. Let that number sink in. $20 million. This isn't client money. This is the broker's own skin in the game. This massive capital cushion serves two critical purposes. First, it ensures that the firm is a serious, well-capitalized entity, not a fly-by-night operation run out of a garage. It filters out the weaker players from the very beginning. Second, this capital acts as a buffer. If the broker experiences operational losses or unexpected market events, it has its own massive pool of funds to absorb the blow, creating another layer of insulation for your segregated account. They are required to use their own $20 million, and likely more, to solve their problems long before they would even be tempted to look at client funds. And regulators don't just take the broker's word for it. Brokers must file daily financial reports with the NFA, detailing their capital levels and the status of their segregated customer funds. It's a system of constant surveillance, not just blind trust. Now, beyond how your money is held, U.S. regulations also fundamentally shape how you are allowed to trade. This is where we run into two of the most misunderstood and debated rules in American Forex: the FIFO rule and leverage caps. Let's tackle FIFO first. It stands for first in, first out. In simple terms, this rule dictates the order in which you must close your trades. If you have multiple positions open on the same currency pair, Say the euro versus the US dollar, you must close the oldest position first. You can't pick and choose to close a more recent, more profitable trade while leaving an older, losing trade open. This rule also effectively prohibits hedging in the same account, which is the practice of holding both a buy and a sell position on the same currency pair at the same time. For many traders accustomed to the anything-goes environment of offshore brokers, this feels incredibly restrictive. Why can't I manage my trades how I want? Is a common question. The regulatory thinking behind this is rooted in a desire for simplicity and transparency, and to protect retail traders from themselves. Hedging, for instance, doesn't actually reduce your risk. It just locks in a loss while you pay the spread on two positions instead of one. For institutional traders with complex multi-leg strategies, it can be a useful tool. But for the average retail trader, regulators viewed it as a confusing and costly practice that often did more harm than good. The FIFO rule forces a more linear, straightforward approach to trade management, eliminating strategies that regulators deem too complex or opaque for the retail market. Whether you agree with their reasoning or not, it's a defining feature of trading in the US. Finally, we arrive at the most significant regulation affecting trading strategy: leverage. In the United States, leverage for major currency pairs is capped at 50-1. For all other minor pairs, it's even lower, at 20-1. This means for every $1 in your account, you can control a maximum of $50 in the market for a major pair like the euro to US dollar. When you see offshore brokers advertising leverage of 500-1, 1,000-1, or even higher, the US cap of 50-1 can seem downright uncompetitive. It feels like you're being forced to fight with one hand tied behind your back. But again, we have to understand the why. Leverage is a double-edged sword, and the higher the leverage, the sharper both edges become. High leverage magnifies both your potential gains and your potential losses. With 500-1 leverage, a tiny market move of just 0.2% against your position is enough to wipe out your entire account. It turns trading into something that closely resembles a casino bet. The NFA and CFTC saw the catastrophic losses that retail traders were suffering due to the temptations of extreme leverage. They made a calculated decision to prioritize capital preservation over the potential for explosive and often unrealistic gains. Capping leverage at 50-1 is a mandatory risk management tool. It's like putting a speed governor on a car. It might prevent you from feeling the thrill of going 200 miles per hour, but it dramatically reduces the likelihood of a fiery, catastrophic crash. It forces traders to be more deliberate, to use more of their own capital for each position, and to think more critically about risk management. It fundamentally changes the nature of trading from a high-stakes gamble to a more measured, business-like approach. These rules, segregated accounts, high capital requirements, FIFO, and leverage caps, form the bedrock of the US Forex trading environment. They are not arbitrary. Each one was born from experience, designed as a specific safeguard to protect retail traders from broker failure and from their own risk-taking impulses. They create a trading ecosystem that is, by design, more focused on security and stability than on the wild, unregulated freedom offered elsewhere. So we have these powerful rules in place, a framework built to protect you and your capital. But knowing the rules exist is only half the battle. How do you, the trader, actually verify that a broker is playing by them? How can you look under the hood and see for yourself in black and white that a firm is compliant and trustworthy? That is where the real power shifts into your hands, and it's precisely what we'll be breaking down next. The answer lies in a free, publicly available tool that is, without a doubt, the single most powerful resource for any US Forex trader. It's not hidden, it's not complicated, but an astonishing number of people never even think to use it. We're talking about the National Futures Association's online database, known as BASIC. That stands for Background Affiliation Status Information Center. Now I know what you're thinking. A government database? That sounds incredibly boring. And you're right, the name is terrible. It sounds like a piece of software from the 90s. But I want you to reframe how you see it. Don't think of it as a database. Think of it as your own personal financial detective's toolkit. It's like having a private investigator on retainer, ready to give you the complete, unvarnished truth about any broker you're considering. So how do you use this powerful tool? It's almost absurdly simple. You open your web browser, go to your favorite search engine, and type in NFA Basic. The first result will take you right there. No paywalls, no signups, no hoops to jump through. The US regulators have made this information transparent for a reason. They want you to use it. Once you're on the site, you'll see a search bar. You can search by a firm's name, but the most precise way is to use their NFA ID number. Any legitimate U.S. broker will have this number displayed prominently on their website, usually in the footer, right next to all the legal disclaimers. If you can't find an NFA ID number on a broker's website that claims to be US-based, that isn't just a red flag. It's a giant, flashing neon sign telling you to run in the other direction. Let's imagine a scenario. Let's call our trader Alex. Alex is new to the market and is looking at two brokers. Broker A has a flashy website with incredible graphics and testimonials talking about a luxurious lifestyle. Broker B has a more subdued, professional-looking website. It's clean but less exciting. Alex's gut instinct, fueled by slick marketing, is leaning towards Broker A. But before he deposits a single dollar, he decides to do his homework. He finds Broker A's NFA ID on their site and plugs it into the basic system. A page loads with the broker's official information. This is where the detective work begins. The first thing Alex checks is the firm's status. Is it NFA member approved? That's the bare minimum. He then looks at the registration types. Is the firm registered as a retail foreign exchange dealer, or RFED, and a futures commission merchant, or FCM? An RFED is a specific designation for firms that deal with retail Forex traders like us. Seeing this is a good sign. It means they are specifically registered and regulated for the business they're in. But this is just the cover of the book. The real story is inside. Alex scrolls down the page and sees a tab or a section labeled Regulatory Actions. He clicks it, and his jaw drops. The page is filled with entries. Each entry is a formal documented action taken against the broker by the NFA or the CFTC. He starts reading. One action is a $50,000 fine for misleading advertising, the very kind of advertising that drew him in. Another is a much larger fine for failing to maintain adequate net capital, meaning at one point, the firm didn't have enough of its own money set aside to protect its customers. There's another for sloppy record keeping. Each entry is a story of a rule being broken, a shortcut being taken. This isn't just a list of mistakes. It's a documented history of the company's culture and priorities. The slick marketing suddenly looks less like confidence and more like a mask. Feeling a bit shaken, Alex goes back and searches for Broker B, the less flashy one. He pulls up their basic profile. He scrolls down to the Regulatory Actions section. He clicks it, and he sees nothing. The page is blank. It says, "No regulatory actions have been taken against this firm." It's clean, crisp, no red ink. The difference is night and day. One broker has a rap sheet, the other has a clean bill of health. But the investigation doesn't stop there. There's another critical section in the basic report. Arbitration awards. What is arbitration? Think of it as a formal, legally binding dispute resolution process. If a client has a serious problem with a broker, say they believe a trade was executed improperly and cost them thousands of dollars, and they can't resolve it directly, they can file for arbitration. An arbitration award against the broker means the independent arbitrators heard both sides of the story and ruled in favor of the customer, forcing the broker to pay damages. When Alex checks the arbitration history for Broker A, he sees a pattern. Several awards have been issued against them over the years for similar issues. This tells him that not only does the firm have a history of breaking regulatory rules, but it also has a history of disputes with its own clients where it was found to be in the wrong. It's a powerful insight into how the company treats people when things go south. He checks Broker B's arbitration history. Again, it's clean. No awards against them. In just 10 minutes of simple free research, Alex has completely flipped his initial impression. The broker that looked the best on the surface turned out to have a deeply troubling history, while the one he almost overlooked proved to be spotless. He didn't have to guess. He didn't have to rely on anonymous online reviews or slick marketing. He had the cold, hard facts directly from the regulator. This process is your shield. It's how you separate the legitimate, compliant players from those with a history of cutting corners. Now you will undoubtedly hear chatter in forums and social media groups about using offshore brokers to get around US regulations. These are brokers based in other countries, often with very light regulatory oversight. They might offer things that US brokers can't, like extremely high leverage. The critical thing to understand here is the trade-off. When you deal with a broker outside of US jurisdiction, you are stepping outside of the entire protective framework we've been discussing. There is no NFA basic report to check for that broker in St. Vincent or the Marshall Islands. There is no CFTC oversight. Your funds are not protected by the same rules. If that broker decides to shut down and disappear tomorrow, you have virtually no legal recourse. It's a completely different universe of risk, and one where your primary tool for due diligence, the basic system, is rendered useless. This is why this simple 10-minute check is the most important trade you will ever make. It happens before you ever fund an account, before you ever analyze a chart or risk a single dollar. It's a trade of 10 minutes of your time for the peace of mind that comes from knowing you are partnering with a firm that respects the rules and has a clean, documented history of doing so. It's about vetting the character and integrity of the company that will be holding your trading capital. Because the platform they offer, the spreads they quote, the charts they provide, none of it matters if the foundation of the firm is cracked. So you've done it. You've used the system. You've found a clean NFA-regulated broker with a spotless record. You're ready to deposit your funds and start trading, right? Not quite. Because choosing a compliant broker is only the first half of the equation. Now you have to play by their rules, which are really the US government's rules. Operating in this regulated environment means your trading itself is subject to a specific set of laws that are unique to the United States. Rules that dictate the maximum leverage you can use, that control how you must close your trades, and that even forbid certain common trading strategies like hedging. These aren't just suggestions from your broker. They are the unbendable laws of the land for US Forex traders, and they will fundamentally shape every single strategic decision you make from here on out. And the two rules that form the bedrock of this new reality are known by cryptic acronyms that every US trader learns to live by: FIFO and the no hedging rule. Let's start with the one that causes the most confusion and, frankly, the most frustration: FIFO, which stands for first in, first out. On the surface, it sounds simple, like a rule for organizing inventory in a warehouse. But in the fast-paced world of Forex, it's a rule that can tie your hands in ways you never imagined. Let's paint a picture. Imagine a trader named Chris. Chris is watching the euro versus the US dollar, the euro to US dollar. He believes the euro is undervalued and is poised for a climb. He enters a buy position, going long one standard lot at a price of 1.0850. But the market has other ideas. The price starts to dip. Chris, still confident in his long-term analysis, sees this not as a mistake, but as an opportunity. It's a discount. So, as the price falls to 1.0800, he buys another standard lot. He's now holding two lots, with an average entry price of 1.0825. This is a common strategy known as averaging down or scaling in. Now the market starts to turn in his favor. The price rallies to 1.0830. At this point, Chris looks at his two positions. His first trade, bought at 1.0850, is still underwater, showing a loss. But his second trade, bought at 1.0800, is now showing a tidy profit. A logical move in almost any other market in the world would be to close that second profitable trade. Lock in the gain, reduce the overall position size, and let the first trade continue to run, hoping it will eventually move into profit as well. It's a flexible, dynamic way to manage a position. But Chris is a US trader, and the moment he tries to close that profitable second trade, his platform stops him. An alert pops up: FIFO rule violation. He can't do it. The first in, first out rule dictates that if you have multiple open trades on the same currency pair, you must close the oldest trade first. In Chris's case, he is legally required to close his first, losing trade from 1.0850 before he is allowed to touch his second profitable trade. He is forced to realize a loss before he can realize a gain. His strategy is completely derailed, not by the market but by a regulation. This is the reality of FIFO. It removes a trader's discretion to close positions in the order they see fit. It forces a linear, chronological closing of trades. Now, why on earth would regulators implement a rule that seems so counterintuitive? The logic, from the perspective of the National Futures Association and the CFTC, goes back to the post-2008 mission to protect retail investors from themselves. They observed that traders often developed a psychological bias. They would rush to close their small winning trades to get that hit of dopamine, while letting their losing trades run and run, sometimes into catastrophic losses, always hoping the market would turn around. They were picking their winners and ignoring their losers. FIFO was designed to stop this. By forcing you to close the oldest trade first, it prevents you from cherry-picking wins while your account is slowly bleeding out from older, deeper losses. It imposes a rigid discipline. It forces you to confront your losing positions head-on. You can't just hide them at the bottom of the pile. This rule, in essence, is a regulator's attempt to enforce responsible trade management. Closely related to FIFO, and in many ways a direct consequence of it, is the no-hedging rule. Hedging, in this context, means holding a long and a short position on the same currency pair at the same time. Let's go back to Chris. Imagine his first trade at 1.0850 is deep in the red. He's worried about a further drop, but he doesn't want to close the trade and accept the loss. In many parts of the world, he could open a sell position on the euro to US dollar. This new short position would profit if the price falls further, offsetting the losses from his long position. It acts as a kind of temporary insurance policy. It hedges his risk, locking his net loss in place while he waits for the market to decide on a clear direction. For a US trader, this is strictly forbidden. You cannot be simultaneously long and short the same pair. If you have a buy order open and you try to place a sell order, the system will simply net them out. It will either reduce or close your existing buy order. You are forced to be directional. You are either bullish or you are bearish. There is no in-between. The regulator's reasoning here was twofold. First, they saw it as economically nonsensical for a retail trader. When you hedge, you have two opposing positions. Your net market exposure is zero. You can't make or lose any more money from the market's movement. However, you are paying the transaction cost, the spread, on two separate trades. You're effectively paying your broker for the privilege of standing still. Regulators viewed this as an unnecessary cost that only benefited the broker. Second, they felt it gave traders a false sense of security. A hedged position isn't a safe position. It's a neutralized position that is actively costing you money to maintain. It encourages indecision and can lead to traders getting stuck in a costly limbo. Together, FIFO and the no-hedging rule create a trading environment that many international traders would find incredibly restrictive. Think of it like this. If trading is a game of high-stakes chess, the US regulations have removed some of the key pieces from your side of the board. You can't use complex defensive maneuvers. You can't play both sides. Your strategy must be lean, precise, and brutally efficient. There is no room for ambiguity. So what does this mean for you, the aspiring US Forex trader? It means your entire approach to strategy has to be built around these limitations. The popular grid trading or martingale strategies, which rely heavily on opening multiple positions and selectively closing them, become incredibly difficult, if not impossible, to implement correctly under FIFO. Your ability to leg into and leg out of positions with finesse is severely hampered. This forces a fundamental shift in mindset. Instead of relying on complex position management after a trade is placed, the emphasis shifts dramatically to the quality of the trade before it is ever placed. Your analysis has to be sharper. Your entry points need to be more precise. Your conviction in a trade's direction has to be higher. Because once you're in, your options for managing that trade are limited. This regulatory framework elevates the importance of one particular tool above all others: the stop loss. Since you can't hedge a losing trade, and FIFO might prevent you from closing other profitable trades until you deal with your oldest loser, the primary mechanism you have to protect yourself from a bad call is a predefined stop-loss order that automatically closes your trade at an acceptable level of loss. It's no longer just good practice. It's an absolutely essential survival tool in the US Forex market. Furthermore, it encourages diversification across different pairs. You can't hedge the euro to US dollar by shorting it, but you can express a bearish view on the euro by, for example, shorting the euro to Japanese yen, or express a bullish view on the dollar by going long the US dollar to Swiss franc. The rules force you to think more globally about currency relationships, rather than just focusing on the internal mechanics of a single pair. It may sound daunting. It may even sound unfair. Many traders have spent years decrying these rules, seeing them as a handicap that puts US traders at a disadvantage. They see a system that strips away flexibility and forces a rigid, one-size-fits-all approach to risk. And from a certain perspective, they aren't wrong. The toolkit available to American Forex traders is undeniably smaller than the one available to their counterparts in London, Sydney, or Singapore. But there is another way to look at this. What if these restrictions aren't a cage but a crucible? A trial by fire designed to burn away bad habits like indecisiveness, hope-based trading, and sloppy risk management. What if this forced discipline, this demand for precision and conviction, actually forges stronger, more resilient traders in the long run? By removing the strategic safety nets, the US system forces you to learn how to fly with nothing but your analysis and a solid plan. It's a tougher school, but some of its graduates become the most disciplined traders in the world. But who are the headmasters of this tough school? Who are the architects of this unforgiving, yet strangely protective environment? It's not some shadowy group or a secret society. It's a very public, very powerful pair of organizations that form the bedrock of financial regulation in the United States. The Commodity Futures Trading Commission, or CFTC, and the National Futures Association, the NFA. Understanding these two entities isn't just a boring legal requirement. It's like understanding the physics of the world you're about to operate in. You wouldn't try to fly a plane without understanding gravity and aerodynamics, and you shouldn't trade Forex in the US without understanding the forces of the CFTC and NFA. Let's start at the top with the big one, the CFTC. Think of the CFTC as the federal government of the derivatives world. They are the ultimate authority, created by Congress, with the power of federal law behind them. Their history is fascinating, starting way back in the 1970s to oversee the agricultural futures markets, things like corn, wheat, and soybeans. But as the financial world exploded in complexity, their mandate grew. Today, they oversee the vast majority of the futures and swaps markets in the US, and that includes retail foreign exchange. Their mission, in their own words, is to foster open, transparent, competitive, and financially sound markets. But what does that mean for you? It means they are the ones who write the overarching rulebook. They are the architects who design the entire playground. They decide how high the swings can go. That's your leverage limit. They mandate the safety features on the slide. Those are the disclosure and risk warning requirements. And they have the authority to bring the full weight of the US government down on anyone who tries to poison the sandbox with fraud or manipulation. They are the ultimate enforcer, the final backstop ensuring the integrity of the entire system. But the CFTC is a government agency. They operate at a 30,000-foot view. They don't have the resources to inspect every single brokerage or handle every individual complaint. That's where the second, equally crucial player comes in, the National Futures Association, or NFA. If the CFTC is the federal government that writes the laws of the land, the NFA is the police force that patrols the streets. They are what's known as a self-regulatory organization, or SRO, which means they are an independent body, authorized by the CFTC, to handle the day-to-day governance of the industry. Every single firm and individual that wants to conduct Forex or futures business with the US public must be a registered member of the NFA. There are no exceptions. It's not optional. This is non-negotiable. The NFA is the gatekeeper. They are the ones who stand at the door and decide who gets to play in this highly regulated sandbox. And getting past them is an absolute gauntlet. Let's just walk through what it takes for a company to become a US-regulated Forex broker. It's a process that weeds out the weak, the underfunded, and the ill-intentioned from the very beginning. First, there's the capital requirement. A firm wanting to be a retail foreign exchange dealer must have and maintain at all times adjusted net capital of $20 million. Let that sink in. $20 million. This isn't revenue, it's not assets under management. It's a floor of liquid capital that the broker must have on hand. Why such an astronomical number? It's a stress test before the stress even begins. It's the NFA's way of saying, prove to us that you can survive a black swan event. Prove that you can weather a storm of volatility without imploding and taking your client's money with you. In many offshore jurisdictions, a broker can be started with a few $1,000s in a rented office. In the US, you need a war chest. This single requirement eliminates 99% of potential bad actors before they can even open their doors. But the money is just the first hurdle. Next comes the scrutiny of the people in charge. The NFA conducts exhaustive background checks on every principal and associated person of the firm. They comb through financial histories, criminal records, and past regulatory actions. Have you ever been associated with a firm that was shut down for fraud? You're not getting in. Do you have a history of financial misconduct? The door is closed. They are looking for a clean, demonstrable track record of ethical conduct. They want to ensure that the people holding the keys to the kingdom are worthy of that trust. And even if a broker clears those first two massive hurdles, the capital and the character tests, the scrutiny has only just begun. Once they are operational, US brokers are subject to some of the most stringent and continuous reporting requirements on the planet. They have to submit detailed financial statements to the NFA on a regular basis, sometimes daily. These aren't just simple profit and loss statements. They are complex reports that show every position, every bit of exposure, and prove that the firm is meeting its capital requirements every single day. It's the financial equivalent of wearing a heart rate monitor 24/7 that's being watched by a team of doctors. The NFA can see the instant a broker's financial health starts to show signs of trouble, allowing them to step in long before a catastrophe happens. This proactive surveillance is a hallmark of the US system. They don't wait for the building to be on fire. They are constantly checking the smoke detectors in every single room. Now, all of this might sound incredibly intense, a bureaucratic maze designed to make life difficult for brokers. And it is. But every single one of these rules, every piece of this regulatory armor, is forged with one primary purpose: to protect you, the retail trader. Let's connect the dots. That $20 million capital requirement? That's your shield against broker insolvency. That's the buffer that ensures the company you trade with is a fortress, not a house of cards. Those rigorous background checks? That's your assurance that you're not handing your hard-earned money over to a convicted fraudster operating from a laptop in a basement. But perhaps the single most powerful protection born from this system is the rule on the segregation of customer funds. In the United States, an NFA-regulated broker is legally required to hold all retail customer money in accounts that are completely separate from the firm's own operational funds. This is a game changer. It means your money is not the broker's money. They can't use your account balance to pay their rent, their salaries, or their marketing budget. Your funds are walled off, protected. If that broker were to go bankrupt, your money isn't lumped in with their corporate assets to be picked over by creditors. It remains segregated, identified as customer property. Think of it this way: with an offshore, unregulated broker, giving them your money is like handing a wad of cash to a guy on the street. With a US-regulated broker, it's like putting that cash in a personal lock-safe deposit box inside a bank vault. Even if the bank itself fails, the contents of your box are still yours. This one rule alone is a powerful reason why many traders, despite the limitations on leverage and hedging, choose the security of the US regulatory environment. Beyond that, the NFA's oversight extends to the very mechanics of trading. They have rules governing trade execution, pricing transparency, and communication. A broker can't just make up prices. They can't fill your order at a dramatically worse price without justification. They are required to have systems in place to ensure a fair and orderly market for their clients. And if you believe you've been wronged, you have a clear path for recourse. The NFA operates a fair and impartial arbitration system, designed specifically to handle disputes between customers and member firms. You don't have to hire an expensive law firm to sue a company in a foreign country you've never heard of. You have access to a US-based, industry-specific resolution process. It's another layer of accountability, another safety net that simply doesn't exist in many other parts of the world. So while the headlines often focus on what US regulations take away, it's what they give you in return that truly defines the landscape: security, transparency, and a system built from the ground up on the principle of consumer protection. The system fundamentally believes that if you're going to participate in this high-stakes arena, the arena itself should be as safe and fair as humanly possible. And this commitment to a safer, fairer arena isn't just a mission statement on a government website. It translates into a set of very specific, very tangible rules that every single retail Forex trader in the United States must operate under. These rules are precisely what make the US trading environment so distinct, and for many so controversial. They are the guardrails, the speed limits, and the mandatory safety checks of the financial superhighway. Let's start with the big one, the rule that generates more debate than perhaps any other: the leverage cap. In the United States, the maximum leverage a retail trader can use on major currency pairs is capped at 50-1. For minor pairs, it's even lower, at 21. Now, if you've ever looked at brokers outside the US, you've probably seen offers that seem almost fantastical by comparison: 200-1, 500-1, even 1,000-1 leverage. It's the difference between being handed a sports car and being handed a rocket ship. The offshore broker's sales pitch is seductive. With higher leverage, you can control a much larger position with a smaller amount of capital. A tiny move in the market could potentially lead to substantial gains. But the regulators in the US, the CFTC and the NFA, looked at that same equation and saw the other, much darker side of the coin. A tiny move against you could lead to catastrophic, account-wiping losses. High leverage magnifies both gains and losses equally. It's a double-edged sword with no handle. The US regulators essentially made a judgment call. They decided that the risk of rapid, devastating losses for the average retail trader far outweighed the potential for outsized gains. The 50-1 cap is like a speed governor on a car. It's not there to stop you from reaching your destination. It's there to prevent you from driving at such a reckless speed that a small mistake results in a total wreck. It forces a more disciplined approach. It means you need to have more of your own capital at stake relative to the size of your position, which inherently encourages more thoughtful, less impulsive trading decisions. Is it restrictive? Absolutely. But from the regulator's perspective, it's a necessary restriction, a seatbelt that you're required to wear, whether you feel you need it or not. Now let's move on to a rule that is uniquely American and often deeply confusing for new traders. The FIFO rule. FIFO stands for first in, first out. On the surface, it sounds like an accounting principle, and it is. But in US Forex trading, it's a hard-coded execution rule. It means if you have multiple open positions on the same currency pair, you must close them in the order you open them. Let's imagine a practical scenario. Say you believe the euro is going to rise against the dollar. You buy one standard lot of euro to US dollar at 1.1000. A little later, the price dips and you see another opportunity, so you buy a second lot at 1.0950. Now you have two long positions, opened at different times and different prices. The market then rallies to 1.1020. Your first position is in profit, but your second, larger position is in even more profit. You might think, I want to close that second, more profitable position to lock in those gains, and I'll let the first one run a bit longer. In almost any other country you could do that. But not in the United States. Because of FIFO, you must close the first position you opened, the one at 1.1000, before you are allowed to close the second one. The first one in has to be the first one out. It's like a line at the bank. You can't just let your friend who arrived later cut in front of you. The natural question is, why? Why enforce such a rigid and seemingly counterintuitive rule? The NFA's logic goes back to preventing certain questionable practices. In the past, a trader might open many positions and then selectively close only the winners to create a misleadingly positive track record, while letting the losing trades accumulate in the background. FIFO eliminates this possibility. It forces a linear, chronological accounting of your trades on a specific pair. It also simplifies the process from a regulatory and reporting standpoint, ensuring that a broker can't manipulate which trades are closed to benefit themselves or a preferred client. It's another layer of enforced transparency, designed to create a level playing field, even if it removes a layer of strategic flexibility that traders in other regions enjoy. This brings us to the third pillar of unique US Forex regulations, the no hedging rule. Hedging, in this context, refers to simultaneously holding a long position and a short position on the very same currency pair in the same account. For example, you couldn't be long one lot of US dollar to Japanese yen and also be short one lot of US dollar to Japanese yen at the same time. To many traders, especially those who use complex strategies, this sounds like taking a valuable tool out of their toolbox. Hedging can be used to temporarily insulate a position from volatility without actually closing it. But the NFA looked at this practice from a retail trader's perspective and came to a very different conclusion. Their argument is simple. For a retail trader, a direct hedge is economically pointless and costly. If you are long one lot and short one lot of the same pair, your net position is zero. You are completely flat. You have no market exposure. Any gain on one position is an equal loss on the other. You are perfectly balanced, going nowhere. However, you are not paying nothing for this privilege. You paid the spread to open the long position, and you paid the spread again to open the short position. You've essentially paid your broker twice to have a net position of zero. The NFA sees this as an inefficient use of capital that only really benefits the broker, who collects the spread on two trades instead of one. They view it as a practice that can confuse novice traders and drain their accounts through unnecessary transaction costs. So they just banned it. If you want to exit a long position, you simply close it. If you want to reverse your view, you close the long and open a short. The end result is the same, but it's cleaner, more transparent, and you only pay the transaction costs necessary to achieve your desired market exposure. It's another example of the US regulatory philosophy in action, protecting the consumer, even from their own potentially inefficient or costly strategies. These three rules, the 50-to-1 leverage cap, the FIFO execution rule, and the no hedging ban, form the core of what makes trading in the US a fundamentally different experience. They are not suggestions. They are hard-coded into the trading platforms of every regulated US broker. You don't have a choice to follow them. The software itself enforces them. This is how the abstract idea of consumer protection becomes a concrete reality in your trading account every single day. It's a system designed to be disciplined, transparent, and to mitigate the most common and devastating mistakes that retail traders can make. But it also means that if you're looking for the Wild West of high leverage, free-for-all trading, the regulated U.S. market simply isn't the place to find it. The sheriff, in this case the NFA, has put some very clear, very strict laws in place. So, knowing these strict rules are enforced not by choice, but by the very brokers you trade with, raises a critical question. How are these brokers monitored? What makes a U.S. broker different? And how do you even begin to choose one in this highly structured environment? What are the telltale signs of a legitimate, compliant broker versus a dangerous offshore operation trying to lure you away from these protections? Understanding the broker's role is the next crucial piece of the puzzle. Your broker is your gateway to the Forex market. Think of them not just as a platform provider, but as the custodian of your trading capital. In the United States, this role is so critical that it's legally defined and heavily policed. A legitimate U.S. Forex broker is officially known as a retail foreign exchange dealer, or RFED, and they must also be registered as a futures commission merchant, or FCM. These aren't just fancy titles. They are legal designations that bind the broker to a strict set of rules enforced by the Commodity Futures Trading Commission and the National Futures Association. Their primary job is to provide you with a platform to execute trades, but their most important legal obligation is to protect your funds and operate in a fair, transparent manner. So, how do you distinguish the fortress from the facade? It starts with a simple, non-negotiable checklist. The very first item on this list, the one you must verify before you even think about filling out an application, is NFA registration. Every single RFED and FCM, legally permitted to offer Forex trading to U.S. residents, must be registered with the National Futures Association. And the NFA makes this incredibly easy to check. They have a public online database called BASIC, which stands for Background Affiliation Status Information Center. You just go to the NFA's website, find the BASIC search tool, and type in the name of the brokerage firm. The result you get back is a comprehensive report card. It will tell you, in no uncertain terms, if the firm is an NFA member. It will show you their regulatory history, any disciplinary actions taken against them, and the individuals associated with the firm. If a broker is not listed here, or if their status is not approved, you stop. Full stop. It doesn't matter what they promise, what their website looks like, or what a review site says. If the NFA doesn't know them, then for a U.S. trader they don't exist. The second item on your checklist is a testament to financial stability: the net capital requirement. The CFTC mandates that U.S. Forex brokers maintain a minimum of $20 million in adjusted net capital. Let that number sink in. $20 million. This isn't just a barrier to entry. It's a massive financial cushion. It's a stress test the broker has to pass every single day. This rule was put in place to ensure that the firm is not a flimsy, fly-by-night operation running on a shoestring budget. It means they have the financial resources to withstand market volatility, and most importantly, to meet their financial obligations to their customers, even in a crisis. An undercapitalized broker is a ticking time bomb. This $20 million requirement is one of the most significant protections you have. Third on the checklist: transparency and adherence to U.S. trading rules. A compliant U.S. broker will have these rules baked into their platform. You won't be offered leverage higher than 50-1 on major pairs, because they are legally forbidden from providing it. The first in, first out, or FIFO rule will be automatically enforced. They are also required to be transparent about their business practices. They must provide clear information on fees, spreads, and how they execute your trades. They can't hide behind vague language. This culture of disclosure is a direct result of regulatory pressure. Finally, and this is a crucial one, check for segregated client accounts. NFA rules mandate that a broker must keep all customer funds in accounts that are separate from the firm's own operational capital. This means your money isn't being used to pay the broker's rent or salaries. It's held apart, earmarked specifically as client funds. Why does this matter? If the brokerage firm were to face bankruptcy or financial failure, this segregation provides a vital layer of protection, making it far more likely that customer funds can be returned, rather than being swept up by the firm's creditors. Now, with this checklist in mind, let's talk about the alternative. Let's talk about the siren song of the offshore broker. You'll see their ads, you'll read about them in forums. They dangle incredible temptations. Leverage of 500-1, even 1,001. Promises of no FIFO rule, allowing you to hedge positions freely. Generous sign-up bonuses that seem too good to be true. And for many new traders, these offers are intoxicating. They see the 50-to-1 leverage in the US as a limitation, a handicap. They see the offshore broker as a path to faster, larger potential returns. But this is the cheese in the mousetrap. Stepping outside the US regulatory framework means you are willingly, and often knowingly, stepping away from every single protection we've just discussed. Let's be clear about the reality. The biggest risk is the complete and total lack of recourse. Imagine a trader, we'll call him Mark. Mark starts with a small account at an offshore broker registered in a tiny island nation. He's drawn in by the 500-to-1 leverage. Things go well at first. He makes a few profitable trades and his account balance grows. He feels like he's cracked the code. Then he tries to make his first significant withdrawal. The request sits in pending for days. He emails customer support. No reply. He tries the live chat. It's always offline. A week later, he tries to log into his account, and the password no longer works. The next day, the broker's website is gone. It just vanished. His money, his profits, everything gone. Who does Mark call? The CFTC? The NFA? The FBI? They have no jurisdiction over a company in St. Vincent and the Grenadines. He is on his own, with no legal path to recover his funds. This story isn't fiction. It's a tragic reality for countless individuals who fall for the allure of unregulated trading. Beyond outright theft, you face a minefield of questionable practices. Because there's no regulator watching, these brokers can engage in activities that would get a US broker shut down immediately. Things like stop-loss hunting, where the broker's platform experiences a sudden, mysterious price spike that just happens to trigger a cluster of stop-loss orders, or severe slippage on every trade, or a platform that conveniently freezes during high-volatility news events. And when you try to withdraw, you're suddenly buried in endless document requests and verification loops, all designed to make you give up. These entities often engage in jurisdictional shell games. They might have a fancy office address in London, but their actual registration is in a location with notoriously weak financial oversight. This is intentional. It's designed to make them legally untouchable. Think of it this way. When you choose a bank for your life savings, do you look for the one offering a ridiculous, unbelievable interest rate from an unmarked building? Or do you choose the established, FDIC-insured institution? You choose the latter because you understand that the absolute first priority is the safety of your principal. Your trading capital deserves the exact same level of respect. A broker's primary function is to be a secure custodian. Everything else, the platform, the tools, the spreads, is secondary. Some people think they can outsmart the system. They ask, can't I just use a VPN to hide my location and sign up with an offshore broker? This is an incredibly risky path. First, you are almost certainly violating the broker's own terms of service, which usually state they do not accept US clients. If and when they discover your true location, which they can often do when you try to withdraw funds to a US bank account, they have a perfectly legal pretext to freeze your account and confiscate everything in it. You broke their rules. By trying to circumvent the system, you hand them the justification they need to keep your money. And even if you get away with it for a while, it doesn't solve the fundamental problem. You still have no regulatory protection and no legal recourse if they decide to simply disappear. Choosing a broker in the United States isn't about a search for the highest leverage or the biggest bonus. It's a search for the highest level of security, transparency, and compliance. The regulations that might seem restrictive are, in fact, your shield. They were forged in the fires of past financial crises and designed specifically to protect retail participants from fraud and insolvency. Choosing to operate outside of that framework is a decision to walk into the wilderness without a map, a compass, or a shield. Once you've chosen a compliant, secure broker, your journey is far from over. Now you've entered a world with its own set of financial reporting rules. How does the IRS view your profits and losses? Is it like stocks, or something entirely different? Understanding the unique tax implications for Forex traders is the final, critical step in operating correctly within the US system. When it comes to the IRS, the world of Forex trading occupies a unique and often misunderstood space. Unlike stocks, where the rules for capital gains and losses are relatively straightforward for most investors, Forex gains and losses fall under a special set of tax codes. The default path, the one you're on if you do absolutely nothing, is governed by IRS Section 988. Under Section 988, your net Forex gains are treated as ordinary income. Let that sink in for a moment. Not capital gains but ordinary income. This means your profits are added to your other income, like your salary from a job, and taxed at your marginal tax rate, which can be significantly higher than the preferential rates for long-term capital gains. If you're in the 24%, 32%, or even higher tax brackets, this can take a substantial bite out of your trading profits. However, there's a fascinating flip side to Section 988 that can be incredibly advantageous. Your losses are also treated as ordinary losses. This is a powerful distinction. With stock market losses, which are capital losses, you can only use them to offset capital gains. If you have more losses than gains, you can only deduct a maximum of $3,000 per year against your ordinary income. Any remaining loss has to be carried forward to future years. But with Section 988 ordinary losses from Forex, you can use them to offset your other ordinary income, like your W-2 wages, without that $3,000 limit. For a trader who has a losing year, this can provide a significant tax shield, potentially resulting in a much larger tax refund than if those same losses were capital in nature. So the default Section 988 is a double-edged sword. Higher tax rates on gains, but more flexible and powerful deductions for losses. But what if you're a consistently profitable trader? What if the idea of paying your highest marginal tax rate on your hard-earned trading profits sounds incredibly inefficient? This is where the IRS provides an alternative path and election you can make. This is called the Section 1256 election. By making this election, you are opting out of the Section 988 treatment and asking the IRS to treat your Forex contracts as Section 1256 contracts. This completely changes the game. Section 1256 contracts have two defining characteristics. The first is the mark-to-market rule. At the end of the year on December 31st, all of your open Forex positions are treated as if they were sold at their market price. You then pay tax on the unrealized gains or take the deduction for unrealized losses, and your cost basis is adjusted to that market price for the next year. This prevents traders from simply holding on to losing positions to defer a tax liability into the next year. It forces a yearly accounting of your entire portfolio's performance, open or closed. The second, and arguably most important characteristic is the 60-40 rule. This is the golden ticket for profitable traders. Under this rule, all of your net gains or losses for the year are split. 60% are treated as long-term capital gains, and 40% are treated as short-term capital gains. This happens regardless of whether you held a trade for 30 seconds or 30 weeks. The holding period becomes irrelevant. Why is this so powerful? Because long-term capital gains are taxed at much lower rates, 0%, 15%, or 20% depending on your overall income. Short-term capital gains are taxed as ordinary income, just like under Section 988. So by making the 1256 election, a profitable trader ensures that the majority of their income, 60% of it, is taxed at these highly favorable long-term rates. For someone generating substantial profits, the tax savings can be immense, potentially adding up to tens of thousands of dollars compared to the ordinary income treatment of Section 988. The choice then seems obvious, right? If you expect to be profitable, choose 1256. If you expect losses, stick with 988. But it's not that simple because of one critical, unbendable rule. You must make the election by the first day of the tax year. For an existing trader, that means making an internal note in your own records before you place your first trade in January. You can't wait until the end of the year, see if you made a profit, and then decide which tax treatment is better. The decision has to be made in advance. It's a forward-looking commitment. This is a trap many new traders fall into. They have a great year, learn about the 1256 election in December, and realize it's too late. They're stuck with the default Section 988 treatment and a much larger tax bill than they anticipated. This preemptive choice introduces a layer of strategy. A new trader might stick with Section 988 for their first year, knowing that profitability is not a given. The ability to write off potential initial losses against their regular income offers a valuable cushion. An experienced trader with a consistent track record, on the other hand, would almost certainly benefit from making the 1256 election to maximize their after-tax returns. Beyond this crucial choice, there's another level of tax complexity: trader tax status, or TTS. This is one of the most misunderstood concepts in the trading world. Many people assume that because they are trading, they are running a business and can deduct all their expenses: computer, software, data feeds, home office. This is not automatically true. The IRS has a very high bar for what it considers a trade or business. To qualify for TTS, your trading activity must be substantial, frequent, and continuous. You're not just managing a long-term portfolio. You're actively trying to profit from short-term market movements, and it's your primary source of income or a very significant activity. We're talking hundreds of trades a year, a serious time commitment, and a business-like approach. If you do qualify for TTS, you can deduct your trading-related expenses on a Schedule C, just like any other small business. This can be a huge benefit. If you don't qualify, you are considered an investor. As an investor, deducting these expenses is much, much harder. For many years, investors could take them as miscellaneous itemized deductions, but tax law changes have suspended that deduction for individuals. This means for most retail traders who don't meet the stringent TTS requirements, those expensive charting platforms and high-speed internet connections are likely not deductible. It's a harsh reality, but a critical one to understand for proper financial planning. And a word of caution about a pervasive and dangerous myth: the idea that using an offshore, unregulated broker somehow exempts you from U.S. taxes. This is unequivocally false. The United States taxes its citizens and residents on their worldwide income. It doesn't matter if your broker is in St. Vincent and the Grenadines or on Mars. If you are a U.S. person, you owe tax on your profits to the IRS. Hiding income offshore is a serious offense that can lead to draconian penalties and even criminal prosecution. The perceived benefits of higher leverage or different trading instruments offered by these brokers are vastly outweighed by the legal and financial jeopardy you place yourself in by attempting to evade U.S. tax law. So, how do you put this all together? First, meticulous record-keeping is non-negotiable. Every single trade, the currency pair, the date and time of entry and exit, the size of the position, and the profit or loss must be recorded. While your U.S.-based broker will issue a Form 1099-B that summarizes your proceeds, it's ultimately your responsibility to ensure the information is accurate and reported correctly. Second, you must make a conscious, informed decision about your tax status. Are you going to use the default Section 988? Or are you going to make the timely election for Section 1256 treatment? Third, be realistic about whether you qualify for trader tax status before you start trying to deduct expenses. And finally, and this cannot be stressed enough, this information is for educational purposes. Tax laws are complex and your personal situation is unique. Consulting with a qualified tax professional, preferably one who specializes in trader taxation, is not a luxury. It is an absolute necessity. They can help you navigate these choices, ensure you remain compliant, and structure your trading in the most tax-efficient way possible. The tax code is the final set of rules every U.S. Forex trader must play by. Ignoring it or misunderstanding it can turn a profitable trading strategy into a financial nightmare. Now that we've navigated the complexities of FIFO, leverage, and even the IRS, what does the future hold? How can you tie all these threads together to build a compliant and sustainable trading journey in the United States? In our final part, we'll bring everything into focus, looking at the road ahead and the mindset required to thrive within this regulated landscape. The journey through the intricate maze of U.S. Forex regulations is not about memorizing a list of rules. It's about a fundamental mindset shift. For many, the word regulation conjures images of restriction, of red tape designed to stifle opportunity. But for the serious professional trader, these regulations are not walls. They are the very foundation upon which a lasting career is built. Think about it. In an unregulated environment, you're swimming with sharks, with no lifeguard on duty. Every broker, every platform could be a potential threat. The rules we've discussed, the oversight of the CFTC and the NFA, the capital requirements for brokers, the segregation of client funds, these aren't obstacles. They are your armor. They are the market's commitment to a level of fairness and transparency that simply doesn't exist in many other parts of the world. Embracing this perspective is the first and most critical step to thriving, not just surviving. So let's bring all these threads together into a cohesive whole. Imagine a disciplined US-based Forex trader starting their day. Their entire workflow is built upon the pillars of compliance we've explored. First, their choice of broker wasn't an accident. They didn't just chase the highest leverage or the flashiest bonus offer. They performed rigorous due diligence, ensuring their broker was registered with the CFTC and a member of the NFA. They checked the broker's history, their capital adequacy, and understood that the 50:1 leverage limit wasn't a punishment, but a risk management tool imposed for their own protection. When this trader analyzes the market and decides to enter a position, the rules of engagement are second nature. They aren't thinking about how to hedge a position because they've built strategies that don't rely on it. The first in, first out, or FIFO rule isn't a frustrating quirk. It's an operational parameter they've integrated into their trade management system. If they have multiple positions open on the euro/dollar, they know exactly which one will be closed first, and they plan their exits accordingly. This isn't reactive compliance. It's proactive strategy. It forces a certain clarity and discipline in trade execution. You must be more deliberate, more precise because the rules demand it. And what about after the trades are closed? Our disciplined trader isn't shoving records into a shoebox. They are meticulous. They understand the tax implications we discussed, distinguishing between Section 988 and Section 1256 elections. Early in their journey, they likely consulted with a tax professional who understands trader taxation to make an informed decision based on their trading style and expected outcomes. They maintain detailed records of every single transaction: the entry price, exit price, date, time, and currency pair. They do this not just because the IRS might ask, but because this data is the lifeblood of their business. It allows them to analyze performance, identify weaknesses, and refine their strategies. It transforms trading from a speculative gamble into a quantifiable business operation. This entire process, from broker selection to trade execution to tax reporting, is a closed loop of professional conduct. The regulations aren't a checklist to be ticked off. They are the operating system running in the background of every decision. This is the difference between a hobbyist and a professional. A hobbyist fights the rules. Professional leverages them. Looking ahead, the regulatory landscape is not static. It will continue to evolve, and the successful trader will evolve with it. What does the future hold? While we can't predict specifics, we can observe the trends. One major area of focus will undoubtedly be the intersection of Forex and the digital asset space. As cryptocurrencies become more integrated with traditional finance, regulators will be looking very closely at crypto-based Forex pairs and the platforms that offer them. Expect more clarity and likely more stringent rules governing these products to ensure they meet the same standards of investor protection. Another trend is the rise of RegTech, or regulatory technology. We'll likely see more sophisticated software solutions designed to help both brokers and individual traders maintain compliance automatically. Imagine trading platforms with built-in compliance modules that prevent you from placing a non-FIFO compliant trade, or that automatically generate detailed reports for tax purposes. This technology will lower the administrative burden of compliance, allowing traders to focus more on what they do best: analyzing the markets. Furthermore, there is a continuous global conversation about financial regulation. As markets become more interconnected, U.S. regulators will continue to communicate and coordinate with their counterparts in Europe, Asia, and other regions. This could lead to a gradual harmonization of some rules, but it also means that U.S. traders need to stay aware of major international financial events, as they can influence the domestic regulatory mood. Staying informed isn't just about reading the NFA's website. It's about having a broader understanding of the global financial ecosystem. This brings us to the most important point of this entire series: ultimate responsibility. The CFTC, the NFA, your broker, they all play a role. But at the end of the day, the person responsible for your trading business is you. It is your responsibility to stay educated. It is your responsibility to conduct due diligence. It is your responsibility to keep meticulous records and to understand your obligations. Complacency is the enemy of longevity in this field. The rules that are in place today might be updated next year. A new interpretation of a tax law could emerge. It is incumbent upon you to treat your trading education not as a one-time event, but as a continuous career-long process. This commitment to continuous learning is what truly separates those who dabble from those who build a sustainable practice. The trader who is constantly looking for loopholes, for unregulated offshore brokers, for ways to beat the system, is playing a short-term game. They are building their house on sand. Sooner or later, the tide will come in. The broker might vanish with their funds, or they may face severe penalties for non-compliance. In contrast, the trader who builds their business squarely within the lines of the U.S. regulatory framework is building a house on bedrock. Their growth might feel more measured, more deliberate. They might not have access to the astronomical leverage advertised elsewhere, but their foundation is secure. They can focus on strategy, on risk management, on psychology, the things that actually determine long-term outcomes, without the constant fear of a regulatory rug pull. They sleep better at night, knowing their capital is with a reputable, regulated firm. They operate with the confidence that comes from knowing they are conducting their business with integrity and professionalism. So, as we conclude this journey, I want you to reframe your entire perception of this topic. Navigating Forex trading regulations in the United States is not a burden to be endured. It is an opportunity to be embraced. It is a call to a higher standard. It's a framework that challenges you to be more disciplined, more professional, and more meticulous than the average market participant. The rules on leverage, FIFO, and hedging force you to become a better risk manager. The requirements for broker registration and capital adequacy provide a layer of security for your hard-earned money. The tax reporting rules compel you to treat your trading as a legitimate business. Every aspect of this regulated environment, when viewed through the correct lens, is a tool for your development. It's the market's way of filtering for seriousness and commitment. The path isn't easy, but it is clear. The journey from novice to seasoned trader is paved not with shortcuts and secrets, but with diligence, education, and an unwavering commitment to operating with integrity within the established rules of the game. That is the ultimate edge, and it's an edge that no market fluctuation can ever take away. The charts, the indicators, the strategies, they will all change. But the principles of discipline and compliance are timeless. Master them and you're not just navigating the regulations. You're charting a course for a truly sustainable future in the markets.